How's it going, world? Welcome to the Fixated on Real Estate webinar series with the best, coolest people that we could find in the entire world to come talk to you guys, or at least the most available people to come talk to us. And in this awesome panel, we have the Brian Burke, Mr. Dave Van Horn, and once again, my good friend, Mr. Jay Scott, who is joining us here today to discuss all the major issues of the world, the economy, real estate, what's happening with it, what to do today, how to navigate all the challenges that are going on that we're all facing here in this incredible pandemic and crisis. So today's webinar, we're going to go over many questions that many of you guys asked in the last webinar that we had with Ken McElroy, Kathy Fettke, and Jay Scott as well. If you want to review that, you can go onto our website, fixatedonrealestate.com, and watch that, or our YouTube channel. Getting started, I want to introduce you guys to the panel. We're going to start with Mr. Dave Van Horn, if those of you guys that don't know Dave. First off, Dave, how's it going? You doing good?
Good.
Awesome. Where are you at right
Phenomenal. Yeah. I'm staying at home. Can't go anywhere.
Perfect. So Dave is CEO and president of PPR Note Company. Which is a holding company that manages several funds that buy, sell, and hold residential mortgages nationwide. Dave's an expert has expertise derived from 30 years of residential and commercial real estate experience as a licensed realtor, real estate investor, and fundraiser. He's also raised over $100 million in both notes and commercial real estate, probably more now. And Dave is also a national speaker and weekly investment blogger on biggerpockets.com. So welcome, Dave. Thanks for joining us. And we got Brian Burke, right? For those of you guys that don't know Brian, he also just had a book. A book is getting released from Bigger Pockets here soon, which we'll talk about in one moment. But Brian Burke is the CEO at Praxis Capital. Brian has purchased over 3,000 apartment units, over 500 single-family homes, and raised over $100 million from investors throughout his investment career. Brian is the owner of Praxis Capital and is a very active contributor on biggerpockets.com. You can learn more from Brian on the Bigger Pockets podcast, episodes 376 and 152. Right? And if you want the best VP podcast, it's episode 189. So Jay Scott, who most of you guys know, Jay Scott is CEO and author at 123flip.com, as well as Bigger Pockets author. If you guys have read his books, there's a bunch of them, and I love every one of them. So he's an entrepreneur and technologist, investor and advisor, host of the Bigger Pockets business podcast, author of 4 Bigger Pockets books, including the book on flipping houses, the book on estimating rehab costs, and the book on negotiating real estate and recession-proof investing. He is a real estate investor that has completed over 400 deals since 2008, including flipping, buy and hold, multifamily notes, lending, development, new construction. He's done it all, right? And now you own other businesses outside of real estate too, right? Which is fantastic. So that said, happy to have you guys here. Happy to be doing this with you guys. And if you're watching this live right now, make sure you guys use the QA box for any questions and the chat box if you guys just want to talk to us. So jumping into it. First question for you guys. Let's talk to Brian. Brian, you are in the commercial real estate space. There's a lot of concern out there for people that have tenants and people that right now have been paying their rents, not been paying their rents. For you personally, I know you have a lot of units. How many tenants right now have you had since April 1st pay rent on time?
Actually, more than we thought. You know, when this pandemic first hit, we were bracing ourselves to see very, very low collections for April and May. Originally, we were a little bit more concerned about May than April because of tax refunds coming in for a lot of people. So we were a little hopeful that would help mitigate the damage in April. And maybe it did, or maybe it was other factors. But so far, we've seen a drop of about 15% on month-to-date collections across our portfolio. And what's interesting is it's not uniform. You know, we have one property where we've collected about 99% of what we collected last month by this same day. Wow. And we have another one where it's like 59%. So it's a bit all across the board, but better than we expected. You know, I think on a blended average, we're in the 80%, 85% range. And from what I'm seeing data-wise from the National Apartment Association, they're doing some surveys across multifamily owners, and we're seeing results very similar to that in the multifamily space. Now, I think if you're a commercial owner, whether you own a retail space, or anything like sporting venues and entertainment venues, they're going to have a little bit tougher time, I would imagine. Fortunately, we have the PPP loan program that's helping a lot of businesses to pay some rent in the meantime, and hopefully that helps continue to do so. And the stimulus checks are giving us some hope that May turn out to be similar to April. So fingers crossed.
So do you have any tenants that are in commercial space that are like business tenants, or is everything multifamily residential?
I do. Luckily I only have one, and of course their business is a personal service business, and it's closed, and they're not paying and not answering the phone. So I think we're probably seeing a lot of that.
Wow, fantastic. Oh, well, I mean, that's across the board. We have a couple commercial properties, and they're on the market to be leased out, and of course it's crickets right now. So and that's a fun experience if you guys have that. But so for those of you guys, for Dave and Jay, for you guys, you're talking to other people. I know that that Dave, you have a few units as well, right? And then Jay, you got some units. What are you guys seeing on your rent side right now as far as rent collections and communicating with your tenants?
So I've talked to a number of people. I've had some detailed conversations with Chris Clothier, who a bunch of you may know. He owns about 5,500 manages 5,500 residential units across a few different markets. And Steve Rosenberg, they manage about 10,000 apartment units across like 10 or 12 different markets. And basically exactly what Brian said, the numbers, everybody's pleasantly surprised. And I have a bunch of single family, but certainly not any significant number from a data sample perspective, but everybody's been pretty pleased with April numbers. The numbers that I've seen, and a lot of them have passed me their numbers, are that they've seen about twice as many missed payments in April as general, but general is typically 4 to 6%. So they're seeing somewhere in the 8 to 12%. And certainly there are people, it's the middle of the month, so there are people that will end up paying later in the month. So it's not nearly as bad as a lot of people have seen. I own a bunch of rentals in military towns. We've had absolutely no problems collecting. So it's for us, it hasn't been too bad. I think April in general is extremely good. And I think May will be the big canary in a coal mine.
Yeah, same thing for me. I mean, May is going to be the question mark. April was really very little to no impact. I don't have that many units, but half of them are government housing. So they all get paid. I talked to my manager. She only manages 1,000 units. So, but she said same thing. April was pretty stable, just a little bit of a hiccup. But May is the big unknown. Will, basically, how many will stop paying in May will be yet to be determined. So that's kind of the anticipation.
I know on our route, we have nothing but single family homes. We don't have anything in our portfolio that's multifamily or anything like that. And in our portfolio, we've had 100% of our tenants pay rent so far. And we hope that continues into May. May is now, for me, the bigger question mark, because now it's continued on. Like in Seattle here in Washington, our lockdown's till May 4th. And we'll see how long that progresses. But I can't help but think that some of our tenants are going to have issues if this continues to go on. And what does that actually reflect? So I want to jump into a lot more details on the landlord rental side. But before we do that, for those of you guys watching, we're going to go over a lot of topics today. So one of the main topics too is going to be what's happening in the lending and credit markets. That's one of the reasons why we have Dave here. He is an expert in that industry. He's in the industry big time. And I'm looking forward to talking to him about what's happening with that. What can you get loans? What's happening with the credit markets? Is it tightening up? What's going to happen in the future? And then Jay, he's been interviewing a lot of business owners over the last few weeks and what's happening in the economy, the new numbers that are coming out. There's a lot of numbers that just came out very recently that are going to be surprising as far as the economy is concerned, that we're going to review with Jay as well. So we have a lot to cover today. Hope you guys enjoy it. Continue to ask questions on the QA box, and we will get to them as we go as best as possible. So that's it. Let's continue down the path of tenants and what's going on in the multifamily residential space in that area. So moratorium right now on evictions seems to be something that is either praised or shunned, depending on what side of the equation you're in. And is it having the positive impact that was expected to have? And is it actually helping people right now in this current crisis? Guys? Brian, do you want to jump on that one?
Well, I guess it depends on your definition of help. The issue is rent is always due, right? And so if you get a break on rent, eventually you have to catch up. And so, people get further and further and further behind. It's really kicking the can down the road in a lot of sense. I think it's important that landlords proactively work with their residents to try to work out solutions that are mutually beneficial, whatever that may look like. And there's a variety of forms that may come in. Somebody in the Q&A box asked a question about what we did to reach out to our residents before the crisis or before rent was due, to be proactive. And that was kind of step one. So, the first thing that we did is we reached out to everyone and said, if you are impacted by this virus, whether it's not you're stricken from it or you've had a work reduction or layoff or whatever, please let us know so that we can work with you. If you don't tell us, we can't help you. And I think smart landlords want to help their residents, and they want to retain their residents. They want to minimize turnover. And so, they're going to work out a variety of different programs with people, whether that means rent deferral or maybe a rent discount for a short time or some kind of a plan for long-term success. The problem is there's some landlords out there that, maybe don't follow best business practices. And so in an effort to protect tenants from those landlords, the government stepped in a little early and a little heavy-handed with some misguided programs of instituting these eviction moratoriums. And while I understand what they're trying to accomplish, it's kind of the wrong tool for the job, especially considering that, when they instituted these a month ago, the pandemic hadn't even closed down a lot of businesses yet. They're already putting moratoriums on evictions. So anybody that was in trouble at that point was in trouble from something that was completely unrelated for the most part. The challenge that it's created that I'm seeing is it creates an unlevel playing field. Having a moratorium on all evictions means that there's no consequences to not fulfilling your end of a contract, and that's led to some people taking advantage of the situation to say, hey, I'm just not going to pay my rent, even though I haven't been impacted, I still have a job, I'm just not going to pay. Why let a perfectly good crisis go to waste? And that's where we're seeing this, ability to pay versus willingness to pay problem come up. Fortunately, it hasn't been as widespread as a lot of owners had feared, and there's just a few people that are taking that approach. But it should be zero, and the moratoriums are going to create problems well beyond what they were intended to solve. When you imagine that, they're in California, for example, the moratorium is supposed to end 90 days after they declare an end to the state of emergency. And how long does it take them to remove a state of emergency? So you could have a moratorium in place for the next 5 months. When they lift it, there's going to be a tremendous backlog on the courts to get those cases processed. And then there's going to be a tremendous backlog with the sheriff's offices to facilitate those evictions. And it's really going to push these things out where, people could string this along for well over a year. And I think that's an unintended consequence of the actions that they took, and unnecessary if landlords would just cooperate with their residents and work with them to keep them in place.
Well, so long as the tenants are cooperating with the landlords, though.
That's right. Yeah, and some of them do, but many of them don't. We out of the non-pays that we have, about 25% of them have been proactive in coming into the office and saying, I've lost my job, here's some documentation, I'll sign a payment plan and do whatever we need to do. The other 75% just simply hide behind the closed door or don't answer the phone. And it's hard to help them if they won't help us help them.
Because just so we're clear, so far there hasn't been any changes as far as I'm concerned. I know here in the Seattle area, it's not this case, that it's not a rent forgiveness, right? Yeah, by any
Correct.
They still owe rent. And if they're not paying rent, then we just can't evict them. So that's right now, technically.
That's true. Rent is still due. I mean, they're not going to forgive rent. The government isn't going to say, okay, nobody has to pay rent. At least I hope they don't take that approach, because that would be really damaging. Rent dollars don't go in the landlord's pocket like a lot of people think. Rent dollars go from the landlord's pocket to a lot of other pockets, and people rely on that in a lot of ways. So it's very important that the flow of money continues. And you're right, it's not rent forgiveness, and it's kicking the can down the road. Having said that, there's a lot of programs in place to mitigate the problem with paying rent, and that is the added unemployment benefits of $600 a week that just started last week. There's the $1,200 per person stimulus that's being put out. That's all of these are intended really. If we really break it down, it's a landlord bailout in a lot of ways when you think about it, because they're putting money in the hands of individuals that with the hope that they'll pay their rent. And if they do that with it and they pay their rent with it, if they choose to pay their rent with it, then that's going to help out all of the downstream from that relies on that money. If they choose instead to go buy weed, then we all have a problem.
So I guess it comes back down to I think one of the challenges, and you guys can chime in, Dave and Jay, is, from my standpoint, I believe it looks like more of a lack of education at times of how economies work and how this moratorium is actually going to pan out for a lack of education. And maybe the media is not doing a good job on that, and who knows. But what do you guys think, Jay and Dave?
I'm working with the people that like to buy weed. So in other words, I end up with the defaulted loans, so to speak. But it's very similar for us. There's a moratorium on foreclosures, right? And of course, we're shifting our revenue buckets. There's 18 states that have stopped foreclosure that we're working with. So we always have a foreclosure matrix and timeline and costs. And really what this does is, to Brian's point, it extends the timeline. It increases the cost. It increases our cost of capital, those types of things. So then we have to offer less for the assets, which means note sales are in direct correlation to real estate values. So you're going to start to see real estate values actually start to go down a little bit potentially from this. I don't know that the retail market's caught up with the wholesale market yet, but it's going to at some point. And what we're seeing pressure like that, because obviously we can't go and buy non-performing assets for the same price we could before the virus started, because obviously there's a lot of uncertainty. We don't know how long it's going to take to eject someone. We call it ejectment, which is really eviction for a foreclosure. And then we also don't know how long the moratoriums will be in certain states, right? So it starts to impact, some of definitely your present portfolio, and on the future stuff, you're offering less, and you don't really have to offer too much less than you normally would to compensate for longer timelines. It's just trying to predict that,
Yeah, I think I don't have much to add. These guys in this space are much smarter than I am. But one thing to point out is we're at April 15th right now. Probably from a landlord's perspective, not the best time for our tenants to be getting their stimulus checks. Personally, I'd rather my tenants get their stimulus checks on April 30th or May 1st, because rent is going to be top of mind at that point. There's a lot of places that money can go between now and the end of this month or the beginning of next month. And a lot of tenants aren't of the mindset, hey, I have to plan ahead. So it will be interesting to see if a lot of the stimulus checks go out this week, as they seem to be doing, if the timing of that is going to impact whether that money is actually used for May rent or not.
That's a great point. And time will only tell, unfortunately. So we'll do another one on May 1st, another webinar, and we'll see what happens then. But I want to switch now gears over to Dave and what you specialize in. So for those of you guys that don't know Dave is in the credit industry in the sense that he buys lots of notes, whether it's mostly non-performing, from what I remember, correct?
Yeah.
So you got a direct line to HUD, Fannie, all those great guys. And you see what's happening in that industry. And there's been a lot of questions and things we've seen on social media. People reach out to us saying, what's happening to all the lenders out there? Why is conventional loans so much harder to get right now? What happened to all the hard money lenders? They're all shutting their doors everywhere. Can you give, for the first phase of this, can you give a very brief description of what happens from somebody originating a loan all the way to ends up somewhere, right? Very brief, like, you know.
Well, yeah, I mean, in its simplest form, there's mortgage originators, and then usually those loans they're just packaged and sold off, right? So they're just really doing it for fees and points, and then they aggregate the loans up, and then someone else is holding those loans. A lot of times it's government agencies, right?
Okay,
And we do buy direct from HUD a lot. We've been fortunate. We've been buying a lot of reverse mortgages, which are deceased borrowers that are vacant. So there's a big difference between occupied mortgages and vacant mortgages. So a lot of the recent moratoriums impact the occupied a lot more than the vacant. So we're kind of insulated from some of that, which is a good thing for us. But some people aren't insulated, right? So, and up until the virus, we were pretty high real estate values. They were back up since the last downturn. Real estate values, generally speaking, around the country were pretty much back to where they were before, 2005, 2006. So what that means is notes were more expensive and the margins were thin. So loans were trading at top dollar, sometimes almost par and things like that. Even on the non-performing stuff was very expensive. Well, what you're going to see happen now is going to be a reset, and you're going to see stuff start to drop. And a lot of it is this uncertainty and the
By
hiccup.
drop, you mean, sorry, just so we're clear, because we're jumping.
They'll start to drop in pricing, and a lot of it's due to what's going on right now. The unemployment is probably the biggest driver for us in the non-performing note world, mainly because there's 4 main reasons people default. It's death, divorce, job loss, and medical. And of course, job loss is the biggest economic indicator to our business, right? So when unemployment, you see where it is right now, it's off the charts. We believe it's going to settle back down towards the end of the year where it might be 5 or 6%. The one thing that I see that's different this time than 2008 and 9 and stuff was that the unemployment was high for a longer period of time, right? And the government was slow to react back then too. It might have taken them 18 months to respond, whereas now they're responding in 18 days, right? So I'm exaggerating, but I'm probably not, right? Jay may remember better than I do. But so it's going to be hopefully a shorter, heightened unemployment, and you'll start to see segments of the market get back in place, whether or not 100% will or not, which really leads us into our buying season. This is, we've been waiting 10 years for this season, so we're actually ramping up and doing the opposite. But we are counter-cyclical to most other, real estate businesses, right? We do great in a downturn, whereas because everything becomes cheaper and more abundant. It's supply and demand, right? It's literally supply and demand. So a couple months ago, supply was thinner. We were paying high prices. There was less product. I have a buddy who runs a fund in New York. They were 600 million. They were down to 200 million, right? So you could see how they were shrinking. So now you're going to start to see it swing back the other way, and you're going to start to see more and more distressed debt.
So what about so you're going to see, so to sum that up though, like the distressed debt you see continuing to go up, but that's for those people that are following. We're talking about mortgages, notes that are defaulting in some capacity, missing payments and so forth. But switching to like the more conventional, the more homeowner side, right? They're getting FHA loans, conventional loans, that kind of stuff. What's happening right now because there's a lot of things being told out there that Fannie Mae is not buying the loans, or Ginnie Mac's not doing it, or the Penny Mac, or what the FHFA is, saying let the servicers keep the loans.
So the biggest opportunity we're seeing in capital markets right now is the non-QM, and that's a qualified mortgage. A qualified mortgage is what you could sell to a government agency. So what's trading back big time now is these like no-doc loans, those types of loans. There's no marketplace for them, just like the marketplace for hard money aggregators is drying up as well. So in the a month or two ago, you would see the Torocs of the world. They would buy up all the hard money loans up in New York. You would see them aggregate up, right? So you'd see there were a lot of hard money originators out there where they don't have as many places to sell those loans off now, because they were in the business of underwriting the loan and making some points and then selling the loan off. And that's another opportunity that we're actually JVing about right now, is we want to do hard money funding and keep the loans. And because the margins are going up and we have some cheaper capital we can marry with institutional money, we're able to actually do that. And, the old hard money loan that might have been 8 or 9, they were on websites almost, right? Well, now you're seeing them be a 10 or whatever. I'm just making up numbers, but you can kind of see how it's inching up, right? And you're also seeing the interest reserves and the payments in reserves are increasing, right? So hard money lenders have to be stricter right now. So you're seeing a lot of commercial lending is getting stricter. A lot of bank lending is going to get stricter. And I think you're going to see, from the shakeup of all the unemployment and, think about it. When you go to apply for a mortgage, say it's 6 months from now or a year from now, there might be a little bit of a shortage of buyers in the marketplace because if I didn't pay my rent or I didn't pay my mortgage, right, or I had a blip in my employment, how do I get a mortgage? And if underwriting's getting stricter, you're going to have trouble getting a mortgage for you're going to have to probably wait till a year after you're back to work or whatever, right? You follow what I'm getting at. So the underwriting's getting stricter, and then people are going to have more blips. So will there be fewer buyers in the marketplace? That'll be interesting to see. It's possible.
So Jay, do you have anything you want to add to that or clarify?
Yeah, I'll just throw out. So there's been a lot of talk over the last couple of weeks about lending tightening, and we hear that term tightening, meaning it's harder to get a loan. And just so people understand basically what's going on here is that, excuse me, typically the way this works is you go into a bank to get a loan. They're the originator of the loan. We call them the originator. They turn around and they make that loan, not because they want to hold this loan for 30 years, but because they plan to turn around and sell it to another company like a Fannie Mae or a Freddie Mac. And so Fannie Mae and Freddie Mac are telling these originators like Wells Fargo or Chase, here are the requirements for us to buy this loan from you. And so Wells Fargo and Chase implement those requirements, and then they sell the loan to Fannie Mae and Freddie Mac. Well, what we're starting to see is that there are a number of banks, including Chase, that are starting to get concerned that in a couple weeks or months, Fannie Mae and Freddie Mac might tighten their requirements for buying these loans. And in anticipation of that, they're starting to tighten their requirements. So we're seeing banks like Chase who are now requiring, I think I read 700 credit score for a conventional 30-year loan. And so as these originators, as these banks that we deal with as normal people start to get scared about their ability to resell these loans, they're going to start making fewer loans and they're going to start tightening up their requirements. So what we're going to see, I think, over the next couple months until this lockdown ends at least, is that it's going to be a lot more difficult to get these loans. And you're going to find that you have to have higher credit score, more assets. You're going to have to prove your income more reliably, things like that. So I think things are going to tend, and we've seen over the last week or so, things continue to get tighter.
You're also going to see some banks do anything to get out of a closing right now. You're going to start to see some closings fall through. It's almost like the bank's looking for anything to get out of that original deal. And they'll utilize that because they don't like where it's going, because they might have to package that loan and sell it off. And now if the requirements are stricter, they're stuck holding the loan. So all of a sudden they're looking for any reason to get out of the deal, right? And you're going to see some deals collapsing. So, I mean, we're doing the same thing. We're trying to get as many closings over the goal line as we can with whatever we have listed or share of sales that we're trying to get everything just to get revenue in the door short term, because we know it's going to slow down and potentially, shift. And at that point, we'll be having to sell the loan instead of the property or the REO, which we tend to make more money on. So when we sell the loan, we get a little less money, right? So it's a little further up the assembly line, so to speak.
This goes back to where, depending on what side of the equation depends on where the opportunity is in this world. And we're talking to investors out there. So a lot of questions we get asked is, where's the investment opportunity and where should I be looking, right? And so this is one conversation that you look at saying, okay, it might be harder for me to buy real estate right now because lending is getting tighter, because back in 2009, 10, 11, 12, like the money was the hard thing to get, right? The deal wasn't. And if you were to go and invest in anything, maybe looking towards what Dave is talking about might be an opportunity later where people might be throwing funds, right? So do you have anything else you want to add to that, Brian, or anything like that?
Well, I just dovetail on what you just said. It's funny how when the market was, really strong, everybody said, I can't wait for a downturn because I'm going to go all in and, I'm going to raise all this money and I'm going to buy all this real estate. And it's going to be really interesting to see how many of those people actually do what they said they were going to do, because what they have come to find out, what I've learned from surviving multiple cycles like this is that it's times like this when it's the most difficult to pull the trigger to execute for a multitude of reasons. Number one is you don't really know where pricing is supposed to be or should be. That's number one. Number two, you don't know if you're going to be able to get a loan, or if so, if you can get a loan, what that loan is going to look like. And third, if you're using syndicated equity, other people's money or partners or whatever to get cash for the deal, there's no time more difficult to raise money from investors than when the market is in chaos. So as much as some may say, well, this is a great buying opportunity, be careful what you wish for.
I've been saying a lot the last couple of weeks that there are so many people that weren't around during 2008 that talk as if like what a recession means is it's exactly like 2016 or 17, except that real estate's half off.
Right.
and they don't realize that no, when real estate's half off or discounted at all, it's because there are a whole lot of other really bad things going on that make the world not a happy place.
Yeah, and there's a whole lot of other people that don't want to or cannot buy for a variety of reasons. And you might be one of those people. So something to think about.
So
it wasn't long ago, there was so much capital in the marketplace, and now liquidity is all crunched, right? I was saying that we were joking around, the three most popular words in real estate were location, location, location. Well, now it's been like liquidity, 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 right? So it's really who has the capital can kind of win. And it is a repeat of that. It's one thing to say everything's fire sale, but nobody had any money, right? So, but I think there is going to be some unique opportunities coming our way for the people that are poised to take advantage of them. And that's really the name of the game, is what you're alluding to. So
we're gonna take a quick poll for everybody that's out there right now, and then we're gonna get back. We're gonna get into some of the questions some of you guys have been asking on the feed, and we're gonna jump into that. But this quick poll is just to see what type of investor out there are you. We just want to know who is in this audience, so we can also make sure we cater some of our questions to the vast majority of you guys there. So you guys got a few seconds to do that. Take that poll. In the meantime, as well, Brian, you had mentioned, did we already discuss cap rates versus prices? Or have we not gotten to that yet?
We haven't gotten to that yet.
All right, let's jump into that while this poll is going. So you had mentioned on a previous call with us that, when it comes to investing in multifamily, so we're going to touch on this just a little bit and not spend a ton of time, but you had mentioned something that people have always invested in cap rates, but right now it's a little different. Can you explain what you mean for that for the multifamily investors out there and what's going on with it?
Yeah, I think what you're referring to, Tarl, is a comment that I made when I said that, cap rates don't change and then move prices. What happens is prices change and that moves cap rates. People think that a cap rate has something to do with investment return, and that as interest rates go up, that means cap rates must go up, or if they want more return on investment, that means cap rates must go up. But, my philosophy has always been that cap rate is not the driver. Cap rate is the passenger. It's simply along for the ride. What changes pricing is buyer and seller sentiment and assumptions. So in other words, if real estate is hot, like everybody wants real estate, cap rates go down because prices went up, right? They pay more for real estate. The same thing happens if there's a lot of rent growth, for example. Rent growth means any income stream is going to grow, and a growing income stream is worth more. So when there's a lot of rent growth, people will pay more for that income stream, which means cap rates went down. Now, when you're in a situation like we're in today, where there's uncertainty in the market, that changes investor sentiment, and people are worried about investing in real estate. They get a little skittish or scared, and they're like, geez, if I'm going to buy this, I need to pay less. Or they say that they want higher investment returns, so therefore they have to pay less. Or they say their borrowing costs are higher, so therefore they have to pay less. Or they say that there's not going to be any rent growth, so I have to pay less. And right now you have all of those things happening, so you have to pay less. And when you pay less, that means cap rates went up. So that's kind of the dislocation, where you're not buying on a cap rate. Cap rate's just the result of all the other inputs.
Thank you for sharing that. One last question real quick on this. So Brianna Schmidt is asking, Brian, do you see a difference in rent collection correlation with asset class?
Yeah, well, I firsthand, only from the experience that I have now with a single family, multifamily, and one commercial tenant. And so far I'm seeing the commercial, my one commercial hasn't paid. and isn't answering the phone. On the residential side, most of the apartment tenants are paying, as well as the single family tenants are paying. So so far so good there. Now I can say anecdotally, without firsthand knowledge, just what I'm reading and what I'm seeing and kind of my sense of the market, is that there will be asset classes that are going to suffer a lot more from non-payment. That's going to be your retail, your office to a lesser degree, possibly even self-storage, if that gets put down on the low part of the people's priority list, and that sort of thing. So I think that's where you're going to find the most risk. There's been some talk about mobile home parks. I'm not quite sure what to make of it, and I'm not a mobile home park operator, so I can't comment firsthand. My feeling is that a lot of mobile home park residents are in the exact category that have been hit hardest by this crisis. The flip side is a lot of them are also retirees who are on fixed incomes that are coming from pension and Social Security and so forth that aren't affected. So not really sure what to make of mobile home parks yet. We'd have to talk to a mobile home guy on that one.
Well, we'll probably have somebody on that, like maybe on the next webinar, because it's interesting too, because most people in mobile home parks, they're renting lot space. And so,
right.
They own the actual unit that they're in. So they don't want to get kicked out and evicted from the lot itself. So that might be something to tie into. We're going to take a very, very quick little commercial break through this. And we are going to, so for those of you guys that aren't familiar with Fixated on Real Estate, if you want to watch the recording of this or any past webinars or get notified for future webinars, go to fixatedonrealestate.com. You can become a free member there. There is probably 200 videos on there from things that we've done over the last 3 years. Some of actually Dave and Jay and Brian are on some of those things as well. So check that out and you'll get notified for future webinars. And also you can see the recordings from past ones and any other content that we produce, including all our expos and all our meetups that we do throughout the year. That said, we also want to recommend our sponsor for this webinar, which is Exact Skip. So for those of you guys that don't know what skip tracing is, if you're a real estate investor out there and you invest off market and you are looking for more leads, more accurate data, Exact Skip is the company to use. It's actually created by real estate investors that use this stuff every single day. And they've processed it in to have accurate skip tracing made very, very easy. It probably is one of the best data and fastest services out there for best pricing for skip tracing. And that's where you can find out things like preferred email addresses, mailing addresses, landline and cell phone numbers, and so forth for your leads and your prospects. If you're direct mailing or you want to cold call or even email, text, and message some of these people that you're actually searching for off-market deals. Any county, city, state in the United States. And if you use the discount code F.O.R.E, you'll get 10% off your order. So check out exactskip.com for all that great stuff. So, all right, jumping back into it. Thank you for taking that break with me. Now, for those of you guys, question. We have Aaron Royce, which is a great question. What's up, Aaron? Right, I bought a deal from Aaron. Credit question. It is recommended to me to max out my HELOC so it doesn't get compressed. Does it look like there's a risk of that happening? Jay.
We don't know. Unfortunately, there's so many unknowns. We don't know what banks are thinking. We don't know where exactly the market's heading. I'd say there's always the risk if you have a HELOC that, let's say, and I think what Aaron's referring to is, let's say you have a $100,000 HELOC and you have $20,000 taken out on it. In 2008, the banks were kind of fond of saying, okay, well, you're only using 20K of that 100K credit. We're going to knock your total credit limit down from 100K to 50K, or even down to that 20K, because you don't seem to be using it. So in some cases, there's the risk if you don't use it, you might lose it. Nobody knows right now what banks are thinking. We haven't seen any bank, and when I say we, I mean I haven't heard of any banks so far that are calling anything due, that are cutting credit lines, that are cutting home equity lines. But who knows? It could happen tomorrow. And it's one of those things that the way the banks typically work is one of them is going to do something and the others quickly tend to follow suit for various reasons. And so right now we have none, but if tomorrow, let's say Wells Fargo started doing it, it's possible that a whole bunch of banks could start doing it. So I don't know the answer, but we're not seeing it yet.
We are seeing it a little bit on the commercial lines where they're, tightening up and they're calling some of them back. There's, definitely some margin calls. So will that trickle into the residential side? It definitely can. my general thinking would be, yes, this is the type of environment that would occur or leading up to it. So, as liquidity gets tighter and tighter, will banks pull back? And if they have to hold loans on their books, right, they won't have the liquidity they used to, and they're going to start looking for places to grab the money. It happened to me. I remember at the last downturn, I had 11 lines of credit, and they started doing that to me. They'll start saying the collateral behind the loan is no longer as valuable as it was, or you're not fully utilizing it, or you're not using this one at all, so we're going to close it out for you, or like they'll create whatever they need to create because they'll have a liquidity crunch on their end, not so much on your end. And you're like, I don't understand. I have a great credit score. What happened to my line? Well, that's why some people do access the lines in, uncertain times, and then they move that money into somewhere else. And it's probably a good idea too, even if you have regular bank accounts and you're having problems making your mortgage payment, don't keep your regular bank account at the bank that has your mortgage, right? You might want to have it at a different bank because they will come in and grab it. So
they made an announcement yesterday relating to that basically if you're applying for one of these SBA loans, like a PPP or an EIDL loan, and the bank that you apply for the loan through is a bank where you have a credit line and you owe money, the bank has the right to take some or all of that loan that you're getting from the SBA and apply it to the loan that you have at the bank. So, I mean, it's just crazy times here. So like you said, Dave, like a lot of things could change very quickly here.
Yeah.
They say that a banker is someone who will loan you their umbrella when it's sunny outside and ask for it back when it starts to rain. It's raining.
Good analogy.
Well,
I love it.
can we really is it really the bankers that are creating this issue, or is it more of the SBA government stuff and all the different regulation that's out there that's creating some of this?
Well, when
Government induced.
Yeah, I mean, there was a big, just before the stimulus package, basically there was a round of QE where the Fed released like $1.5 trillion into the market, and part of the changes that were implemented when that happened was the Fed said banks no longer are required to have any capital reserves, literally zero. And so at this point, I know banks are starting to shore up their reserves, especially over the last couple of days. But legally they are no longer required to have any reserves, and that can quickly have ramifications for us.
Well, especially since they can't sell their loans, right? And so how are they going to be able to continue funding those if they can't sell them off to any of the GSEs that are out there? Yep. And that creates major issues and liquidity issues and possible, very bad issues for the most part. So I want to also jump in. So there's been some so let's continue going down the doom and gloom route for a second. And then we'll maybe talk some positivity before we wrap up. Jay, right? There's been some new market data that's come out there. What's going on with the economy? Some numbers been released for first quarter. Do you want to share some of that? And also, if you have a report or anything like that, you can add into the link in the comment section or something like that. If they have any articles, that'd be great.
Sure, I'll link some stuff when I'm done talking. But let me start with anything that's being reported today either happened last month or last quarter. And last month was part of last quarter. And we all know that what's happening today isn't necessarily a reflection of reality. So I could tell you, we could be at 100% unemployment. Nobody could have a job today. That doesn't mean that this is a forever thing. I mean, at some point, the lockdown is going to end. We're going to get back to a steady state. We can talk about where that steady state might be. But today, what we're seeing, banks announced earnings. So Wells Fargo, Chase, Bank of America announced earnings today. They were down about 50% year over year. So huge negative earnings there. Banks have a lot of that has been the result of the banks pulling out billions of dollars and putting that into reserves for losses that they're expecting moving forward. So it's not really as bad as it seemed. But if they have to use up those reserves for the actual losses they're expecting, then yeah, it's actually as bad as it seems. We saw retail numbers came out today, and retail sales in March were down 8.7%. Just to give you a benchmark for what what 8.7% means. In the worst part of 2008, which was the worst retail numbers we've seen in the history of the country, we saw almost 4% down. So 8% down is actually huge. But again, everything's closed. It doesn't necessarily mean that the world's collapsing yet.
Yeah, not everybody can do online sales. So
and not everybody can do online sales. Exactly. And even Amazon, I don't know about you guys, but I've tried to order stuff off Amazon recently and it's a month out. So I'm ordering my books in other places. And the manufacturing from March was released today, and manufacturing, what they call utilization. So the amount of capacity that's in our manufacturing infrastructure was down from like 77 to 72 or 73% utilization, which is the lowest number since 1946. But again, I mean, businesses aren't operating, so there's no reason for manufacturing plants to be operating. The bigger question is, where does this go when the lockdown ends?
Yeah.
The way I see it, I think of it this way. Imagine we have this sponge, and the sponge is our economy, and it's filled with water. It's filled all the way to the brim with the water, and we squeeze it out. And that's kind of what's going on right now. We're squeezing out, that's unemployment, that's manufacturing, that's retail sales, and we're just squeezing out that entire sponge. At some point, we're going to start to reabsorb those employees. We're going to start to reabsorb that demand for products. We're going to start to reabsorb everything, but we're probably going to be doing it with a smaller sponge. A lot of those businesses aren't coming back. A lot of those stores aren't coming back. A lot of the consumer demand might take time to come back because people have lost income for several months. So we'll reabsorb those jobs. We'll reabsorb that income. We'll reabsorb the manufacturing, the productivity. But it's not going to be we turn the switch off and we turn it back on. Most likely we're going to reabsorb 80 or 85 or 90% of that. And when we get to a steady state after this crisis, we could see unemployment at, instead of 25% like it likely is now, we could see it at 6, 7, 8%. Which is so much better, but 6, 7, 8%, that's recession numbers. Mm-hmm. So my take is that once this is over, June, July timeframe, hopefully, we're going to see typical recession numbers in terms of GDP, in terms of unemployment, in terms of manufacturing, in terms of retail. And then the big question is, from that steady state recession, does it go up and everything improves, or do things get really bad and everything drops? And that's the bigger question in my mind.
So I guess that's the $1 billion question or $1 trillion question, depending on where you're at. But in the real estate market, isn't there stats out there that show, and statistics show, that through historically over the last 100 years or whatever, through most recessions, real estate actually doesn't get hit as hard as the rest of the industries out there. Maybe that happened in 2008, 2009, right? But that was a mortgage crisis more than anything. But is it to say that if the Great Recession happens, which it definitely probably will right now, is that going to actually have a negative impact on real estate? Because what about inflation? Inflation has a factor in that and so forth. And I mean, Brian, do you have input on that, or what are your thoughts?
Well, in 2008-ish, that recession was caused by real estate. It was a real estate collapse that caused that recession. So real estate definitely took a really strong hit. In the dot-com bubble of, the early 2000s, I almost didn't feel that as a real estate investor. My tenants were paying rent, houses that I was flipping were selling. It was kind of almost a non-event for me. This one, I think, is going to fall somewhere in between. Because, it wasn't caused by real estate, it was caused by an outside factor, but real estate is ultimately going to be affected for a number of reasons. Right now we have massive number of people that are sidelined from work, right? So as Jay, put it much more eloquently than I ever could about, how many people are unemployed and the percentages and all that other stuff. From a practical perspective, I think about things like, how long is it going to take for people to get back on airplanes, to go to sporting events, to go to the restaurant, to go to the movie theater, to go to concerts and festivals. And these are all places where people spend money, and a lot of people work at those kind of venues. Think about conferences, events. Tarl, you've got a big conference coming up, and
tell me about it.
Right. So, there's a lot of those kinds of things where if some of those events don't happen, then some people that otherwise would have had income are not going to have that income. And that means that they can afford less. And maybe that means there's rent declines, or maybe there's increases in vacancy. We don't know yet how that's all going to shake out. My personal feeling is what really happens, because the economy, aside from what's happening now, was fundamentally strong. Do we go to a scenario where we have flat rent growth? Maybe there's no rent growth for a year or two. Occupancies hold up fairly well. Bad debt increases. Concessions increase just to maintain occupancy. Values take a short-term hit because incomes are reduced. I'm talking about commercial real estate incomes, at least in the multifamily and residential sectors. And then start to climb back up. So, there's a lot of talk about, is this a V-shaped recovery, a U-shaped recovery, or what does it look like? And, I've been saying all along, and I still believe this to be true, I think that this looks like the Nike symbol, where the swoosh, where you have this immediate drop followed by a long and gradual climb back to where you were. And I think that's what we're going to see. And, I think it's going to take some time. I don't know if that's going to be 6 months, 1 year, 2 years. My guess is it's probably a year to a year and a half, but I guess we'll see.
Yeah, I think I agree with Jay, where the GDP is going to be down 20 or 30% this quarter, but it's going to start to go back up third and fourth quarter. And I kind of see what Brian's saying as well. Our outlook here at PPR is more of we're not going to really have an economic solution until there's a health solution. And, Brian's hitting all around, and it's really, it doesn't necessarily have to be, a vaccine. It could be testing, for example. So you'll see like that company, Abbott's, for example, they're doing all these tests, right? We're going to have supposedly 20 million tests by June. Well, that's going to enable us to start to get back to some kind of normalcy where it is safer to go back in certain areas and segments of the market. And until that happens, it's really how long will this thing last, right? So how long will people feel safe to be able to get back? So it's going to take some form of medical treatment. It's going to be a multitude of these medical things. And once these medical things are resolved, then of course you got the stimulus that's going to help out. But until some of this medical solutions come along, the economy just can't get itself back until some of that takes place, right? That's what I'm pretty much a firm believer in that. Until you have some kind of medical solution, you're not going to really have an economic solution all the way,
Yeah, I talk a lot about the three things that I think are the potentially catastrophic risks to our economy. And the first is exactly what you just said, Dave, which is we don't know how long the lockdown is going to last. Is it going to be 2 more months? Is it going to be 12 months, 24 months? Is it going to be rolling lockdowns that kind of ebb and flow for the next 2 years until there's a vaccine? We don't know. And that's a huge risk that we enter more of these type of lockdown periods over the next couple of years. The second is just, you can agree with me or disagree with me. I know a lot of people disagree with me, and that's okay. I saw a lot of things in the economy leading up to this event that I thought were worrisome. I don't think we were in the greatest economy in history, as some people like to believe, leading up into this event. I mean, corporate debt is at an all-time high, and consumer debt's at an all-time high, and manufacturing was already having some issues, and retail was already having some issues, and GDP, even with the tax cuts that we saw 2 years ago, and even with lowering of interest rates, GDP was still down around 2%. I mean, it really, to me, it felt like we were lowering interest rates and just kind of keeping things afloat. So I think there are a lot of things, especially those debt numbers, that can really start to cascade or domino down from all of this. And if that happens, I mean, things can get ugly really quick. And then the third thing that I see as a potential catastrophic risk, and this is one that's harder to predict, but is just what are the unintended consequences of $5 trillion in stimulus or $10 trillion in stimulus? What are the unintended consequences of $2 trillion being rolled into the repo markets? What are the unintended consequences of moratoriums on evictions and foreclosures? What are the unintended consequences of all these things that the government's doing that, don't get me wrong, they have to do it. We have to do this. But there are so many things that this has never been done before. There are so many things that can break in ways we have absolutely no idea. We've already seen it with the servicer market. We've already seen it with loans and basically MBS rates affecting interest rates and mortgage rates. And I mean, there have already been unintended consequences. Those just grow, and the risk of those continue to grow. And something could happen at some point where it causes a cascade in a way that we've just never intended or imagined before. So those are the three risks that any of them kind of play out to any degree, things can get really bad really quick. I feel like we're kind of in an economy right now that's being held together by Scotch tape, or maybe if we're lucky, duct tape. And all it takes is for one or two things to break, and you just get a domino cascade effect.
Well, what about the sense of, should all those things, should it lead to hyperinflation or any kind of higher inflation? And we're speaking specifically with real estate, like, does inflation help real estate assets, or does it actually hurt real estate assets? Typically,
a little bit helps real estate, but massive inflation is going to hurt everybody for a whole lot of reasons. I'm sorry, I'll let Dave answer.
I mean, traditionally, real estate's always been a hedge against inflation, but there's so many moving parts. It's, I don't know. I scratched my head this time around.
Guess that makes sense. What are your thoughts, Dave? Brian?
Yeah, I agree. I mean, we talk about real estate being a hedge against inflation a lot, because generally when there's an inflationary environment, rents are also going up. Having said that, I mean, what if they don't? What if inflation is to the point where people can't afford for rents to go up any higher? That could be an issue. I generally think that inflation helps real estate. But it's like a recession. Every recession looks different, and I think every inflationary cycle is going to look a little bit different. I would place my bet on it helps, but there's always a chance that it does the opposite.
I don't see wages going up.
Yeah, I mean, there's a term that we've probably all heard. I'm not sure how many people really are familiar with it, but it's called stagflation. And it's essentially the idea that you can have inflation. Typically with inflation, inflation's driven by increased productivity. Because you have increased productivity, businesses have to keep up with that demand. So they have to buy equipment and warehouses and more inventory and hire more people. And that costs money. So they pass that cost on, and that raises prices. So typically inflation and increased productivity go together, but not always. There are times when you can have inflation, like from printing way too much money and never pulling it out of the economy, where you have a lot of inflation, but you don't have a corresponding increase in productivity. And that's kind of where Japan's been for the last 25 years. They've kind of been in this inflationary environment without any increase in GDP or productivity, and they've been struggling. And so I'm not saying it's going to happen here, but it's a risk.
Yeah. So let's end on a opportunistic topic, right? Or that said, what's the silver lining in this? Where is the opportunity? How do people wake up excited and looking towards the future? Because we can continue to think doom and gloom. I have a belief that one of the major issues with this is that I don't want to get down this topic too much, but I think it's going to create a bigger division between the haves and the have-nots. I think the people that have the have-nots are going to get the most affected on this, unfortunately, and it's going to get a wider economic gap on that. That said, if you're in a place right now to look for opportunity, whether it's now, 6 months from now, a year from now, where is that opportunity in your opinions? And we'll start with Dave.
I'm a little biased, but I think there was a time when I would say cash flow is king. Right now, I'm kind of saying cash is king, and distressed debts. This is our buying season, like I mentioned earlier. We're approaching that, and for us, there's going to be an uptick in distressed debt, and prices will be cheaper. And it's just a cycle, and it's just being aware that cycle is approaching, and it's all hands on deck for us. So.
Jay.
So from a real estate perspective, I don't know. I do know that there will likely be opportunity. You look back over the last 10 years and there's different opportunities at different times. I mean, at one point, REOs was a huge opportunity. At another point, multifamily syndication was a huge opportunity. Short sales have been a huge opportunity. Development's been a great opportunity at certain points. Lending's been a great opportunity. I mean, there's always going to be opportunities, unfortunately, without knowing how exactly everything's going to play out. But this is why it's so important for people not just to ask, what should I be doing, but to actually educate yourself on what's happening, how the economy works, how the markets work, how different things impact each other. So you can say, hey, I'm seeing X, Y, and Z. Therefore, I think the opportunity is going to be over here, as opposed to just waiting and saying, okay, where's the opportunity? Really understanding these things. I know this is not real estate related, but we look back at 2008, 9, 10, 11, and with the tremendous real estate crash, it was probably the best time in at least modern history to be buying real estate. I mean, it just opened up opportunities that we haven't seen before. I think with the business crash that we're seeing now, and the likelihood that a lot of businesses aren't going to return over the next few months, people that just decide, nope, this is the right time to shut down, or people that were planning to retire and they decide, okay, well, now's a good time to retire, or businesses that just don't make it. There are going to be millions of businesses that don't make it. I have a feeling that the next couple of years are going to be the equivalent in business to what 2008 to 11 was for real estate. So if you're an entrepreneur and you're looking to kind of expand outside of real estate and get into business, this could be the greatest opportunity we have in modern history to be starting or buying a business. So start looking at that. And I'm going to do a quick little plug. If you listen to the Bigger Pockets Business podcast this week, we had a guy on named Nigel Geisinger, and he's brilliant. And his strategy is he buys businesses that own their underlying real estate. And then he will rehab the businesses, eventually sell the businesses off, but he'll hold the real estate, and the person that buys the business now becomes his tenant. And so if he sells with owner financing, he's got essentially a lien against the real estate, because if they don't pay on the real estate, he takes back his business. So It's just, it's basically two opportunities to grow value there. So it's just a really interesting strategy. So listen to this week's Bigger Pockets Business podcast. But if you're interested in business, now's a fantastic opportunity.
Agreed. Fully. And actually, you had me thinking about that for the last couple of weeks, and I've been digging into that. And I also agree with something you said very earlier, which was right now is the time to study economics, right? And right now, if you were not a student of this, you have the time, become a student of it, and don't get pigeonholed in one thing. Start looking and understanding how economies work. Brian, you have a book coming out in a week or two, something like that?
Tomorrow.
Tomorrow. All right. Tomorrow. And that's through Bigger Pockets. And before you say your opportunity, what's the title of the book? Where can they buy it?
The book is titled The Hands-Off Investor, and it's an insider's guide to investing in passive real estate syndications, and they can get it at biggerpockets.com/syndication book.
Awesome. And then where is the opportunity now, future? What's up?
So I think in the short term, call it, between now and 3 to 6 months from now, I'm in Dave's camp. I wholeheartedly agree. The opportunity is in distressed debt. We've been after this opportunity for the last month or so, and we're gearing up to take advantage of it in a pretty big way without stepping on Dave's toes.
I need to hear that now.
Yeah, well, playing a different playground, but I think that's where there's an opportunity right now. I look at it from, at a time like this, the biggest thing is risk mitigation. And if you want to make an investment, be at the bottom of the capital stack, and that's debt. So I think distressed debt is really a very good play right now. When you kind of look a little further out and you get to 6 to 12 months from now, I think there's going to be some opportunities in commercial real estate. So if you're thinking about going into the commercial real estate space, now is the time to study up, get documents ready, have your lawyer work on writing your offering documents, talk to your investors and all that sort of stuff to get ready to pull the trigger on a commercial real estate investment when you feel that time is right. And I think that's going to be, somewhere third or fourth quarter of 2020. When you get into next year, call it first quarter of 2021 and maybe through the first half of 2021, I think you'll see opportunities in the single family space, especially for fix and flip type operators, because you're going to see some of this distressed debt result in foreclosures and other things, or just distressed sellers. They're going to be getting rid of single family homes, and that's going to create an opportunity to flip single family homes that hasn't been around in quite a few years. You know, when the market was in total chaos in 09 through 2014, I was flipping 120 houses a year. And in the last like 5 years, we've probably done maybe 10 houses a year. That's how much it went down. I don't think it's going to come back like 2008 or 9 again, but I don't think it's going to be as much of a desert as it was over the last few years. So that's kind of my short, medium, and long-term view.
I think what Brian is saying is multifamily apartment syndication is not a good strategy ever, and nobody else should ever try it.
Don't ever do that. Yeah, and Dave is saying don't
I'm
ever
gonna
do
try it about a
distressed
year,
debt.
so you
Exactly.
guys don't
Dave
try
said-
it. I'm going to try it.
So and I just want to, in my head, you said something, Brian, that I actually agree with for opportunity where I see it's at, and that is in the single family space, but on the distressed debt, but from other investors. That's how I see it. The hard money lenders, the immediate future in my head, the next 3 to 6 months, is those lenders that invested, those private money lenders that invested in the single family space, to investors that were possibly newer investors that are in the fix and flip realm, or were looking to burr, or whatever it might be, and they can't finish their projects, they can't keep the capital up, and those hard money lenders are willing to sell at extreme pennies on the dollar just to get rid of that debt, because they can't sell the loan also, right? Because nobody's buying it. And a lot of hard money lenders can't sell their loans right now. So if they can't sell it, and it's non-performing, and they have an investor, and they kept to close the doors because they can't keep it open, so they can't keep the real estate, they're going to sell that debt. And that's where I see some of the opportunity is investors cannibalizing other investors for the people that have the liquidity to be able to do it, and the skill to be able to handle a project that is halfway through rehab with red tax, right? So if you can do those, I think that's where some opportunity is going to be for sure.
Exactly what we're talking about, Tarl. You know, distressed debt doesn't mean that it even has to be in default. It could be fully performing, and then the lender might be the one in distress.
Right.
And that's what we're looking at as lenders that are in distress, much more so than borrowers that are in distress.
Absolutely.
The distressed borrowers will come in 3, 4, 5 months. Right now, it's distressed lenders who are going, oh my God, what am I going to do with all this debt on my books that I can't do anything with?
Everybody needs to remember that real estate is all about solving problems. It's not about us. It's about everybody else that's out there that has a problem. And our job is to solve that problem. And during times like now, there are a whole lot of people that have a whole lot of problems that weren't problems a few months ago. So figure out where the problems are, figure out who the people that have these problems are. And that's going to answer the question of where are the opportunities.
Well, I need to be respectful of time. Dave has to bounce off. I know that. So we're going to say goodbye to everybody. I want to really thank all the panelists for being on here. Where can they reach you, Dave, if they need to get in touch with you?
Either on Bigger Pockets, I'm on there all the time, or at pprnoteco.com, pprnoteco.com.
Perfect. And then Jay Scott?
jscott.com, jscott investor on Facebook, jscott_123flip on Instagram, and check out the Bigger Pockets Business Podcast.
And of course, Brian Burke.
Yeah, either on the biggerpockets.com forums, praxcap.com is our company website, or Instagram, which I hardly ever use, Investor Brian Burke. I got to figure out how to use that social media stuff. Still working on that.
Yeah, you don't like that stuff. And we're going to be doing
these. Can I plug the book real quick?
1 second. So we're going to be doing these every 2 weeks. And so we'll have another one coming up May 1st. So be on the lookout for that. And you can check us out, me at Tarl Yarber on Instagram. And then are you plugging Brian's book? Because we plugged it again earlier a second ago.
I'm going to plug his book and mine.
Dude, go for it.
And Dave's. I need to plug everybody's
books for everybody.
I do have to run, guys.
Books for everybody. So
Thanks,
I'm about halfway through Brian's book, even though it's not released, and it's absolutely amazing. So definitely check out Brian's book. It's released tomorrow. You can pre-order it now. Dave's book on note investing. I mean, we talked about all the opportunities in notes. Go check that out. Bigger Pockets as well. And for anybody that wants to learn more about the economy, my most recent book is called Recession-Proof Real Estate Investing, and it's all about economic cycles and how to invest throughout all parts of the economic cycle.
So there are a tremendous amount of questions that did not get answered, just like every webinar we do. And a lot of great questions out there. We're going to continue to look at these questions and try to get the answers for you guys as much as possible. So keep tuning into these. There'll be future little clips and stuff and future episodes of these type of webinars for you. all the time until the world gets better, which I don't think that's going to happen anytime soon. So we'll keep doing it. Make sure you guys check out exactskip.com and use your discount code F.O.R.E for exactskip.com if you're in that market. It might be a good time to start reaching out to people too. Any last words, guys, before we sign off?
Life is good. If you're struggling right now, keep in mind there's going to be tremendous opportunity and it will get better. And use this time. If you're not using this time to actually be out there investing and taking action, that's okay. Nothing wrong with that. Use this time to get prepared for when the opportunities really present themselves in a few months.
Amen.
I'll just say that my business grew exponentially after the last downturn. So, you know, downturns can lead to growth and opportunity. All you have to do is survive. If you can survive it, you can thrive when you get to the other side. So just remember, survival is job number one.
And all I got to say, my final thoughts, and we can sign off, is that I am so grateful and so thankful that it has not been easy for me to do this business, and that I've had a lot of ups and downs, and I grew up very, very broke, and I've lost a lot of money. I've made a bunch. I've had my business go up and go down, and I've done all that because I feel sorry for people that haven't had that happen to them. Because times like these is when you've had failures and you've had back sets that you can actually go like, okay, I've been through this before. I can get through this again in some capacity. But if it's been nothing but uphill for you, I feel sorry for you. So it's because this is going to be an interesting time. So for most of you guys, so I'm grateful for that. And I'm just, saying my last piece on that. But all right. So it's okay if it keeps getting tough, guys. It makes you stronger, and just survive and thrive. Brian, Jay, Dave, who disappeared because he had another call. So we thank you guys, and I'll see you guys again in the future.
Thanks, guys.
Thank you.